Good morning traders and welcome to Trade Coach. This video will teach you how to place a trade from start to finish. If you want to take the fast route to becoming a successful trader, you first need to know how to place a trade. This is my 8-step execute process to placing a trade. I've incorporated unknown but essential steps like spreads, position sizing and placing an order. So sit down, relax, it's time to take your first steps towards becoming a pro. Make sure you head over to www.trade.coach to subscribe to our mailing list and receive the step-by-step PDF guide for placing your trade. Step number 1 is to open your chart platform. I'd recommend creating a free account with tradingview.com and using their charts for the following reasons. Unlimited range of asset classes, freedom to pick any time frame, unlimited range of indicators, alerts, replay mode, range of drawing tools, ability to stay in drawing mode, range of text options, advanced price analysis tools, advanced harmonic tools, risk to reward tool, measuring tool, and favorites toolbar. With features like that and the simplicity of navigation, TradingView is like a haven for all traders. Depending on your trading strategy, you need to make sure your charts are ready to begin analysis. As a price action trader, my charts are ready when all irrelevant indicators and features have been stripped away and I can see the price clearly. If you use indicators, then you want to make sure all the indicators you need for your strategy are ready on your chart. Step number 2 is to read the market situation. When I say read market situation, I mean paying attention to what's important to your strategy and waiting for your trading strategy to generate a signal. For example, my trading strategy is a bat pattern trading strategy. When I look at my charts, I'm looking for the beginning signs that a bat pattern is forming. This means I'm paying attention to each and every leg and measuring it using my Fibonacci retracement tool to determine if my bat pattern is forming. No matter what you trade, this is the preparation stage of your strategy. This is where you're identifying your setup, is in the early stages and gauging where the market is. Step 3 is to identify the trade setup. This is where we identify a potential trading setup by consulting our entry rules. In the case of my bat pattern trading strategy, the entry rules are simple. A bat pattern is a harmonic pattern which needs 5 separate legs from X to D which fulfill different criteria. For example, my X to A leg can be any impulse leg. For my A to B leg, which follows the X to A, I need a minimum of a 50% Fibonacci retracement of X to A and price can't touch the 61.8% retracement. These are the rules I use for identifying a bat pattern. I use the example of my bat pattern to show you that this works with any strategy. You basically just need to use your entry rules like a checklist, and when everything's checked off, you have a trade setup and it's time to move on to the next step. In this case, I can see that I have a bearish bat pattern forming, which sets me up to place a short trade. Step number 4 is to identify our entry, stop loss, and profit target. These are the rules I use for my bat pattern trading strategy. In this case, my entry price is at my D completion point, and to calculate my D completion, I use an 88.6 Fibonacci retracement from the X to A leg. This is my entry point. My stop loss is positioned 10 pips above my X leg, as this is the point that I no longer want to be in the market if the price exceeds this point. My target 1 is calculated from a 38.2% from A to D, and my target 2 is calculated from a 61.8% from A to D. So my entry price is 1.17098, my stop loss is 1.17435, my target 1 is 1.16395, and my target 2 is 1.15960. Step number 5, we ask ourselves the question, is our risk to reward acceptable? Generally, you want to make sure you're at least set to profit 1 pip for every pip that you risk. This is called a 1-to-1 risk to reward ratio. If we were to risk 100 pips, we need to at least make 100 pips if the trade wins. You can calculate risk to reward using the risk to reward tool in TradingView, which you can see on my screen, or you can just work out the number of pips between your entry price and your stop loss, which is your risk, and the number of pips between your entry price and your profit target. For example, this is a short trade. So to work out my risk, I take away my stop loss from my entry price, and this gives me my risk of 33.7 pips. This is where it gets interesting. Because instead of having 1 target, we have 2 targets for this strategy, we need to work out the profit for each separately, add it together, and then divide it by 2 to calculate our risk to reward accurately. For our first trade's profit, we take our entry and subtract it from our target 1, and we get 70.3 pips. For our second target, we do the same. Take our entry price and minus it by our target 2, which gives us a reward of 113.8 pips. Now what we do is we add them together. This gives us a total profit of 184.1 pips. And then we divide this total profit to get our overall profit of 92 pips. In this case, our risk to reward is 2.72, which is our profit of 92 pips divided by our risk of 33.7 pips. So in step number 6, we're accounting for our spreads. It's essential to account for your spreads on every single trade that you place, just to ensure that you're actually getting filled at your entry price, you don't get stopped out early, and your profits get taken at the price that you set. Every broker will show you two prices, the bid price and the ask price. The bid price is the price that you see on your chart when you're doing analysis. The ask price is slightly higher than the bid price, and this is so your broker makes money on every trade that you place. In order to calculate the spread, you take away the bid price from the ask price, which gives us 3 pips. So the spread is 3 pips. This is the formula you use for accounting for spreads when you place a trade. When you place a long trade or a buy trade, you need to add the spread to your entry price, and your stop loss and profit target remain the same. When you place a short trade, you need to add the spread to your stop loss and take profit, and your entry price remains the same. Let me show you how to account for spreads using our trade as an example. So as we're placing a short trade, our entry price remains the same, and we add the spread to our stop loss and our take profit. Now that we have amended our stop loss and our targets, we're ready to calculate our position size. Step number 7 is to calculate position size. The simplest way to calculate your position size is to use a position size calculator. To find a position size calculator, search Forex position size calculator in Google and select any one. For this tutorial, I'll be using Baby Pips position size calculator. First, you need to select the currency that your account is in. In my case, this is GBP. Then you enter your account balance. As an example, let's use an account balance of £10,000. Risk percentage refers to your risk management rules. So how much are you willing to risk on each trade? Let's use 1% as our risk percentage. Stop loss is the distance between your entry price and your stop loss. Make sure you account for your spreads by using the guidance from the previous step. Now we select the currency pair that we're trading with. And finally, we need to enter the ask price for the currency pair listed at the bottom. In this case, Great British Pound to the US dollar. And in the right side, this shows us the number of units to risk when we're placing our trade to ensure that our risk is capped at 1% of our account balance. Step number 8, our final step, is to place our order. So the first thing we do is log into our broker account and we open the trading window. Then from the trading window, we're going to select the currency pair we're using and open the order window. Once the order window is open, we need to ensure that this order is set to pending. This is because our strategy is currently setting up and we don't want to enter at the current market price, and so we need to put in a pending order. Then we need to ensure we select a buy or sell option. In this case, we're predicting the market will fall, and so we're selling, and so I'll select a sell limit order. Then we enter our entry price in the at price option. For volume, you need to understand what measurement your broker uses for position sizes. My broker uses standard lots, but your broker might use mini lots, micro lots, or units. My position size calculator tells me that the volume I need for a trade risking 1% is 0.3551 lots. As my broker uses 2 decimal places, let's round that down to 0.35 lots. If we had one profit target, we place one order and use 0.35 lots for our volume. But because we have 2 profit targets for this trade, we need to place 2 orders risking 0.175 lots each, which is 0.5% risk on each trade. Now I enter my amended stop loss and target 1 with spreads added. I'll also add a note in the comment section of the strategy, trade direction, and the target for this order. And then we press place to put the order out into the market. Next, we repeat the same process for the other half of our trade for our second target. Once that's done, we can press place again and put the other half out into the market, and then we're done. Thanks for taking the time to listen. Be sure to subscribe to this channel for future videos. If you want early access to all things Trade Coach, head over to www.trade.coach and subscribe to our mailing list. Thanks for watching, and I look forward to when you turn pro.